Ew. All right, let's go live, kids. It has been a morning fraught with technical difficulties, but we got it done. Let's see what we can get going here with the live stream. I've been, there we go. Loud as hell, but let's fix that. There we go. Hey, Isabella, how are you? Let's fix this.
And just crank out more gold out of the ground. It's not happening.
All right. Now, the Fed is also meeting not the only central bank, by the way, that's in focus this week.
All right, I'm going to refresh this browser one more time just to make sure. Welcome, everybody, to the live stream. It is rate cut day. Yo, Isabel. Let's get this going. You should see the screen to my upper right here. There you go, that one.
I will start with you, Barbara, on this.
Let's get it going. It is going to be an exciting day. Before we get too far into this, the countdown is largely to be expected to be a 25 basis point rate cut. So the real sexy sensationalness here is not what is happening right now in the rate cut room. It's the discussion that's going on there. So we got to figure all that out. Let's get this bad boy here a little bigger, and then we will watch it in real time like we did on the last show, which I think is a much better presentation here. There we go. There we go, full screen. All right. Welcome, everybody. Welcome, everybody. Let's get the rate cuts here going. Let's listen to the conversation. To set the backdrop, if you do recall, we have a Chicago Mercantile Exchange, Bloomberg World Interest Rate Probability, all putting this at a lock at 25 basis points of a rate cut. What's interesting is this is largely one of the Fed's first conversations about rate cuts in which they do not have data because of the Fed shutdown. Combine that with a lot of what you're seeing in the markets as it relates to jobs and some of the other tertiary red flags. We covered a lot of that on episode 306 of the Higher Standard. You saw a pretty changing landscape, but some inconclusive, if you will, statements on what the market's going to be. So let's listen in a little bit and let's get to it.
Citibank and JP Morgan have been good trades. You know, we've been in Barclays, we've been in Santander, and I just think the international allocation, we're seeing this. We're seeing a lot of inflow. The dynamic here is U.S. investors are underweight international. U.S. exceptions, I'm not here to challenge that. In fact, I would just say that there's an underweight U.S., there's an underweight international by U.S. investors. There's an underweight their own markets by foreign investors. And I think some of this really started back in Trump 1.0, where I think we went from, like, foreign investors went from kind of, 18% to 25 to almost 30% U.S. I think some of that's coming back. I think international is a long-term trade.
All right. Coming up on the show, a quarter-point cut is more so baked in at this point. So many investors are sitting on their setting their sights on the Fed balance sheet.
So let's take some time to explain that. More or less baked in really means what happens in the Treasury market is people try to get smart. And what they do is they say to themselves, okay, we know that the Fed is likely to cut rates. And if they are going to cut rates, we want to get ahead of that. So we're going to offer advantageous pricing in the market. And that advantageous pricing is usually reflected in the form of mortgage rates. So you'll see the Treasuries come down a little bit ahead of it. You'll see mortgage rates come down a little bit ahead of it. And the classic mistake you typically see with people in the business of, for example, real estate or other tertiary businesses, is they say, oh my God, rate cuts now, mortgage rate cuts later. And actually what you typically see is you see mortgage rates start to creep back up after you see a rate cut. That's because all the smart people, all the smart money, these big institutional corporations that set mortgage rates, that really define the market, they have cut rates leading into this because they're looking at the same things that we look at in the show that we often share with you. That's world interest rate probability. That's the Bloomberg's world interest rate probability. That's Chicago Mercantile Exchange. They're looking at the Treasury markets. They're looking at all this stuff. And the way this works on a macro scale is, let's say I am a mortgage originator and I'm going to originate loans. Well, if I'm going to originate loans and I want to get volume, I can originate loans today. Let's just throw out a number here at 6%. But if I know the Fed's going to cut rates and we're going to see the Treasuries drop a little bit, I can cut my mortgage rates, call it 10, 15, 25 basis points, and capture more business that I know is money good. And why is it money good? Because when I go to sell those loans in the secondary market, mortgage rates are saying that is at or above current market rates. So that's how they play this kind of volume game by trying to get ahead of the traffic of these during a rate cutting cycle. You see the opposite trend during a rate hiking cycle, where you'll see mortgage rates and people in the market, for example, car loans, also same thing. They'll increase rates ahead of a rate cut because they know that the loans they make today at, call it again, 6%, when those rates go up to 6.25%, are going to be worth less in the secondary market. So when they sell them to generate liquidity, they don't have the ability to sell them at par or better. So they're trying to maintain money at all times, which is why you see the market react in advance as opposed to reactively, and that's just the smart money play. Let's take a look at some of the data that I've seen recently. We're going to cover a little bit of this on the show tonight, but I do want to share the employment sector is really showing signs of weakness, and I would fully expect the Fed to talk about this on at some point. And let me get out of the full screen here. And here we go. This is, and you can probably see this really well. I'll just make this nice and big so everybody can see it real well. Title here. UPS, 48,000 employees. Amazon, we thought was up to 30,000 employees that have lost their jobs. It was 14,000. Amazon citing AI and technology growth. You got Intel at 24,000 employees. Nestle, 16,000. Accenture, Ford, Novo Nordisk, Microsoft, PwC, Salesforce, Paramount, Target, Kroger, Applied Materials, and Meta. And Meta's actually had a couple series of rounds, so the number isn't as big as it would otherwise look here. But very fascinating stuff. I don't know that we're going to see a really strong conversation. These are the Treasury conversations. Let's take a look at this here. This is also very important as part of our conversation with the Fed today.
With the market already pricing in a 1/4 percentage point cut, my next guests are now focusing on the potential end of quantitative tightening. So joining us now are Michael Schumacher, head of macro strategy over at Wells Fargo, and Ross Mayfield, investment strategist over at Baird. Thank you, gentlemen, both for being here. Michael, we're going to start with you.
Ross coming strong with the hair.
This is probably one of the more telegraphed rate moves that the Fed has seen, and the markets are playing it that way as well. What exactly do we need to see or hear from the Fed later on today with regard to what the next steps are for Wall Street?
Yeah, Dom, it is telegraphed. I agree with that. And it's not simply because you've got this move just about baked in, but there's been effectively no economic data for the last month. So nothing really to change the Fed's mind in terms of the path. What people are focused on is the balance sheet. Is Powell, is the Fed going to announce that today is the day the Fed stops running it down? Probably not, but it may actually do it for forward start. So it might do this for December 1st or something like that. I think the big surprise to the markets would be if the Fed said, no, we're good. We'll just let the balance sheet run down a bit more and we'll evaluate next meeting. That would be a shock.
Michael.
So that's an interesting point too, is, the Fed really has no data to rely on coming from government sources. So for them to make a decision, they're essentially making it in the blind and with private party reports, which I don't know necessarily is a bad thing per se. And it certainly isn't changing the narrative of what they're going to do. But it's also the reason why you're not going to see more aggressive cuts, because they just don't have enough information. The managing the Fed's balance sheet and jobs in and of itself will probably be the likely larger conversations that you're going to hear them talk about today. And, I don't know, man. I look at some of the stuff that we're seeing here so far, and it's so, I don't know, speculative. Just because you don't have data, the market seems, on one hand, to have all-time highs. You saw this morning, you had NVIDIA hitting an all-time high market cap, which shows the market super strong. You got AI and tech stocks carrying the S&P 500. You've got all the signs that would otherwise be strength, but there is such a thing as being too strong of an economy. And I think that we're seeing that, but people are afraid to say that because they don't want to get labeled a recession or fear monger person. I'm not saying any of those things, but I'll say that there are red flags. And look, here you have the treasuries going up again.
All right, Ross, from an equities perspective, how much is the rate picture necessary for the next leg hypothetically higher in the marketplace?
Look, I think it's a leg that the bull market stands on, but it's not the main one, right? We know the AI trade is primarily fueling this. Now, there is a lot of easing baked into the market. So I think on one hand, the idea of lower interest rates, sparking some of the cyclical corners of the market, the housing trade, for instance, is important, but it's also baked into the market. I mean, we look at Fed fund futures, and again, 100, 125 basis points more of easing, plus the end of QT, which is more, easing of financial conditions. So it's clearly a big part of this. We don't have a lot of data points, but Fed rate cuts plus no recession has been a very potent mix throughout history. And I think we're sitting there today, but it's far second to AI and the developments on the front of the Mag 7 and some of the other players in that space.
Yeah, but see, that concerns me a great deal. When you've got AI leading the way so much so that they're talking about that's really carrying the market, it's a known thing, then you've got what I call, concentration risk in the market. You've got exposure to one particular industry, which has, we talked about this in the show in a great deal, which has mass broad exposure to a lot of us and how we feel and what we do here. The treasuries, like I pointed out, are actually going up. So you're seeing the treasuries go up a little bit on the previous charts, the 10-year and everything else. You're going to see them dip a little bit throughout the day and be a little bit of, probably essentially be flat is probably where you'll wind up. And then tomorrow you'll see them rise a little bit, then again pushing mortgage rates slightly back up from where they are today. If you're in the mortgage or real estate business, getting your clients to lock ahead of this would probably be a wise idea, because you might see the treasuries creep up a little bit and mortgage rates kind of stabilize as a result of it. Here you go. Year to date, they're down 12.27%, but the change for today is up, 29 basis points or so. So I think you're going to see, again, the treasuries are already starting to climb a little bit, knowing that this rate cut is baked in. And when they say baked in, again, when I'm going back to the very beginning of this show is they have cooked in this, the market has cooked it in. They're expecting 25 basis points unless there's some kind of weird, shocking lack of a cut or a rate increase. By the way, the probability of not having a cut is 0, and the probability of a greater than cut, probability of not having a cut is 0.6% leading into this, and a probability of having a greater increase in rates is 0. So this is going to happen, statistically speaking. And the quantitative easing and quantitative tightening and some of the balance sheet mechanisms they're talking about, that's really important for liquidity in the market. And you're going to see more and more of that discussion happen. But I think most people generally don't understand it. And basically, it's a simple supply and demand money game, right? The Fed puts more money into the market. The Fed takes money out of the market. And these two mechanisms are how they control monetary supply, and really how they're trying to control how much liquidity is there. That being said, what I will say is that market is typically much more impactful, but I think with the rate cuts being so low, in my experience, that where they are today and where we've come from, I don't know that you're going to have a material change in the economic zeitgeist because they change their policy and how they handle the balance sheet and liquidity on it. It should have a longer lasting effect, but the headline news will always be the rate cuts. Remember, as a reminder, if anybody has any questions or thoughts, please jump in and ask. Otherwise, I will be entertaining questions throughout the episode. We are going to go over some more data ahead of tonight's podcast as well, stuff that we're going to be talking about on that show. We're going to talk a little bit about kind of some of the headline risks that we're seeing around jobs and some of the layoffs that I brought up earlier. I am growing more and more concerned that the layoffs that we're seeing as a result of this AI hype are starting to become real and meaningful. And because of those layoffs and changes in the economy, you could see a Fed slowdown. You are expecting potentially 2 more rate cuts before the end of the year. And I think that's probably a realistic expectation. But are we planning to get back down to, call it a near 0 rate environment? No, I think you're going to see rates stabilize. I don't think you're going to see them go much below, what their current status is now on the mortgage side. And there's a number of reasons that are economic triggers for this in the market, not the least of which is you have to understand how banks operate. Banks, generally the largest provider of loans, there are private party loans in the market, make money on something known as spread. So the difference in what they pay you on your deposits versus what they make on loans. And over the course of the last, call it now about 15, 16 years or so, we were at an all-time interest rate deflated economy. Interest rates were hyper low. So you saw some interesting things happen in the market as a result of that strange economy that we were living through. Chiefly among those, you saw interest rates on the loan side go down to super low rates, mortgages in the 2.5 range, for example. And then you saw people getting hyper competitive for deposits, liquidity. So they were paying higher and higher for deposit rates. And that's why you saw these headlines about high deposit rates and super low loans. Well, that's going to kill bank profits. And now that you're seeing this happen, those margins are widening now, right? So mortgage rates have crept back up to a normalized level, if you will, and your deposit rates, if you look at your deposit accounts, if you have a checking and savings account, those numbers have dropped. And that's giving a wider spread, a wider margin, right? So the interest on loans minus the interest on deposits they're paying, that's how much that's their core profits, that's their net interest margin. And because of that delta increasing, you're also going to see a lot of bank M&A in the coming months. You're going to see a lot of banks merge, community, regional, super regional banks. That's going to happen because profitability is coming back, and a lot of these people who were looking to get out before can now sell down their positions in banks or get away from them at a higher multiple. Multiples in the secondary market are based on your earnings and your income and your revenue potential, and it's easier to show that when you're much more profitable than you were before. So if I was making loans at 2.5%, now I'm making loans at 5%, I've literally doubled my profits, even if I kept a static deposit rate situation. And what you're also going to see as part of this rate cut, even though the Fed funds rate is not directly connected to mortgage rates, you are going to see banks drop your rates in your deposit accounts as a result of this almost instantly. Some of them are a little bit more forthcoming with how they do it and when they do it, and they tell you. Others are not. So you need to know that if you've got a high yield savings account, for example, or you have something that doesn't have a fixed rate like a CD, expect those rates to drop in line with this decision today. If not by the end of today, certainly by the end of this week. So let's hear what we're talking about now on CNBC.
Your favorite part of the market right now?
I tell you, it's not a big weighting, but I really like what's going on in commodities. I like what's going on in integrated miners. Again, I talked about copper. I think industrial metals. I think the defense spend build out around the world, whether it's Japan or Europe. I kind of like that part of the market. Industrials have led the S&P all year.
Barbara, what do you think?
Still the AI chips, you know, NVIDIA, Broadcom.
Shocking, Barbara.
TSM. So.
Okay, so heading to the Fed. Thank you guys both very much for breaking it down all with us right now. Barbara Duran, also Tim Seymour, thank you very much for that. Now, that does it for the exchange. We're just a few minutes away from that big Fed rate decision. I'm going to see you on the other side of this break on Power Lunch for the entire Fed breakdown. Keep it right here. We'll see you after that.
All right, for those of you who do not watch CNBC, there have and always will be buzzwords that are market sensitive at any given time. This economy is no different than any other economy. We're certainly seeing a lot of buzzwords, and we're certainly seeing a lot of things become more and more trending, obviously AI being the most notable one of those, but precious earth, rare earth conversations are happening a whole hell of a lot. You're starting to see more conversations around jobs, around the idea of bubbles. How high can this go? You even see the talking heads talk about that on CNBC. So you're going to see these as reoccurring themes that get exasperated by what the Fed is going to announce today in their decision when it comes to a lot of what we're hearing. So I think you're going to hear a lot of fodder. Again, the gold in this will not be the announcement. For those of you who do not watch these a lot with us or cover this in the podcast, here's what happens. The FOMC comes out with a statement which is largely almost identical to its previous statement with some words changed. And because we expected the last one to have a 25 basis point rate cut and now this one to have a 25 basis point rate cut, there will be very few words that are different from the last press release to this press release. So there's not going to be a huge material difference here. If anything, it's going to be the changes that are going to be, looked at under a microscope, but it's really going to be the press conference afterward. And that's why we do this as the FOMC live rate decision and the press conference, because the press conference is really the meat of this whole thing. So if you're watching and saying, Chris, I'm bored already, I'll explain to you, you're supposed to be. This is not the exciting time. The exciting time is really the afterward. These are the talking heads. A lot of people who are going to pontificate and suggest a lot of different things, myself included, on what may or may not be happening. I try my best not to do that because I think a lot of the rhetoric that you get from the Fed afterward is really where you should focus, not necessarily suggesting where the markets go. So the lead up to this is always about telling you where we're at, kind of the status quo, letting the Fed come out and do what they're going to do. Here we know what that's going to be, a 25 basis point rate cut. And then we're going to do what you're going to hear the most about afterward, and we're going to break down live the real input that we're getting from the FOMC and some of the thoughts that we're hearing. You should hear a very different tone from Jerome Powell. It should be much more focused on cutting rates and being responsive to the market. You should hear him be less hawkish and more dovish, if you will, because he doesn't have a whole lot of data. He's not going to have a huge degree of confidence in knowing absolutely for sure where the market's going. I think that the lack of data is going to be a continuing conversation throughout the day that you're going to hear him use to respond. And then, of course, housing affordability stuff always comes up. So here we go, back on it.
All right, welcome to Power Lunch. I'm Dominic Chu in for Brian Sullivan today. We are just about, call it less than 5 minutes away until that very key Fed rate decision. We're going to bring you that decision, the market reaction, and what it all means for your money straight ahead. But first, let's get a check on the markets. All-time highs for each of the major indices out there. The S&P's up 0.25%.
That's
fractional
scary.
Gains for the NASDAQ
That's
Composite.
wildly scary.
The Dow Industrials, the NASDAQ 100 Large Cap Index as well. Right now, let's get right to our all-star panel as we get just closer and closer to that big Fed rate decision. Joining us now are Jim Caron of Morgan Stanley Investment Management, David Kelly of JP Morgan Asset Management.
David Kelly,
also
stud.
Francis Donald of RBC Capital Markets. Again, all-star panel to break all of this down. Let's first, though, get out maybe have
David
the
Kelly
conversation
always
a little
looks
bit first
super
about
stoic.
what's happening overall for that big rate decision coming up. We're going to get out to Steve Leisman. Actually, we're going to stay right here. We'll get to him in just a moment. He's in lockup right now. So, David, we're going to start with you.
That usually means the announcement's
This is
getting ready.
perhaps one of the more telegraphed, if you will, rate decisions that we've had in recent memory. Is there anything that we're going to expect that could change the narrative one way or the other based upon not just the decision, but what we hear from Jerome Powell in 30 minutes after that decision comes out?
I think on the rate cut itself and on the prospects, it is pretty much telegraphed to markets. But I think the interesting issue is going to be quantitative tightening. We've seen some spike up in short-term rates. They've been gradually reducing their balance sheet. I think they're going to come to an end to that. I put an end to that because they don't want to cause volatility in short-term markets. So I think that's the first thing. And then it'll be really interesting, the press conference, to see just how far the Fed is telegraphing rate cuts. Are they really slowly coming down to neutral, or are they going to stop short of that if the economy is looking fairly strong?
Do you think that it would be in their best interest to do that, or do you think that they want to keep things in more of a wait and see to provide that optionality?
Obviously, wait and see.
When and if data actually starts coming out again.
If I were in their shoes, honestly, I wouldn't cut at all.
Wow.
And the reason is I think the economy is doing okay, but these markets are bubbly, and
they are overinflated.
Animal spirits running rampant here, and when you go to the zoo, they say don't feed the animals. I think the Federal Reserve shouldn't feed the animals here. I think they should not feed these animal spirits at this point.
Good for you, David Kelly. Good for you.
Jim, are we feeding the animals or not?
Well, look, I like to differentiate between the market and the economy. The economy's not the market's not the economy. So when I think about this, I think about the jobs market. And what I'm going to be looking for in this decision and the commentary from the Fed is how are they assessing the data? What private sector data are they looking at, or what other indicators are they seeing? Because ultimately what it means to me and what I think it means to the Fed is if the labor market is slowing or non-dynamic, then what we need to see is further rate cuts. Yes, I know that the inflation is above target right now, but as long as the unemployment rate is likely to rise, and by the way, I think the unemployment rate is truly closer to 5% than the 4.3% that we last got, based on some of the private market surveys.
I would agree with that.
So I think the Fed is very wary about that, and that probably puts a couple more rate cuts in front of them.
All right, now, Francis, if we turn towards you.
Yeah, but see, that's a bad strategy. And I kind of agree with David Kelly that not cutting would probably be a savvier decision if it weren't for the politics and kind of the overall zeitgeist. If you have a market at this top bubble, largely because you've got the S&P driven heavily by one sector, AI, and you're going to hear this over and over again. If you're cutting rates and you're giving them greater profits, just the interest in their loans going down, mostly C&I business loans or on adjustable rate loans, you're giving them much more headway up. But as jobs are getting stressed, he's saying, okay, the Fed has two mandates, right? This market stability, and then they also have the jobs, the unemployment number. And he's saying the unemployment's high, so you have to cut rates to get that unemployment number back down in line. Okay, fine, all good. He believes it's a little bit higher, and he's already acknowledged that inflation is higher than target. So technically keeping rates up should be the focus, but they're focused on the jobs piece now, not on the inflation. They believe that it'll stabilize. Here you see the non-farm payrolls, total difference to period. They're going to start citing some weird data in this one. So if you haven't heard of some of this data before, don't freak out. They just don't have the typical resources that they use to do that because of this government shutdown. I truly believe that we are in a weird time, in a weird economy, because if you do cut and you focus on the jobs, then you're pushing the market higher, which in theory could ultimately drive inflation back up. I'm not saying that it will. That could absolutely theoretically happen. So the Fed is at a bit of a crossroads. In serving the one master here of jobs, you have the risk of causing inflation.
By a quarter point to a new range of 3.75 to 4%. There were two dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Schmidt, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into T-bills. It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators, one of two nods in this statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cutting by a quarter, two dissents on both sides of the issue. One wanted more, one wanted none at all, and the Fed stopping quantitative tightening.
All right, so the Fed stopping quantitative tightening is an important differentiation here. We knew they were going to talk about it, but what's really, really valuable is that they're acknowledging that there's volatility in the short-term treasuries. They're going to try to stabilize that by stop bringing in liquidity and start buying T-bills, putting their money into the markets to help stabilize that near-term treasury risk. The other part of this, which is interesting, and I'm looking at this, is the dissenting. You know that Myron, who was Trump's appointee, has been hyper-aggressive on the last trade. So for him to come out and say, hey, guess what, guys? We need a 50 basis point rate cut, not 25. That is not surprising to anybody. He has been the aggressive outlier. What is surprising is the other side of the equation, where you have somebody who aligns with David Kelly here from JP Morgan Chase, suggesting that no rate cut is needed. And what he's basically saying, without saying it, but with just his vote, is he's essentially saying, I am more worried about inflation than I am about jobs. We don't have enough data to look at for full reporting, so we're going to need to see a little bit more information before I feel like an additional rate cut is needed right now. Now, that is certainly not what certain political parties want to hear. That's certainly not. Politicians, regardless of what political party you align with, they all want a stable, good economy because they don't want to be associated with one or the other, but they're certainly going to play a good and bad economy off one another. So there's political reasons here that nobody talks about. It's kind of that underlying thing that's just nobody's ever going to bring up, but it's real. Yo, Saeed, what's up, my guy?
Does this change at all anything with regard to how you view future allocations, how new client money gets put to work? What exactly does this mean in the construct of how investors have to view what this rate decision will mean for them?
Well, I think the one interesting thing was that dissent in terms of not cutting at all from the Kansas City Fed president. I think that is really interesting because it says that there's some pushback, and I think the pushback isn't about the economy. I think it is about how strong markets have been this year. And if that gathers a little momentum, we may see a Fed easing a little bit more slowly next year. So maybe not heading straight down to 3%. In terms of investors here, I think it's been a wonderful year for investors, but that follows two great years. And I would say rebalance, rebalance, rebalance. I mean, I think people just need to look at the risk side of their portfolios and not just the very strong gains that we've seen in equity markets.
Francis, you used the word, I'm going to bring it up again, you used stagflationary as part of your response to my previous question. Do you feel any differently or similarly based upon what you heard from Steve? I know that we're going to break down the entire kind of report and the press conference afterwards, but do you still feel as though this is a market that is going to succumb to stagflationary pressures in the coming months?
Well, we have the qualifier stagflation light, in that this is clearly a long way from the 1970s, but look at what the statement says. It flags exactly that scenario. We have job gains that have moderated. We have inflation that has moved up. And that's okay for right now because the unemployment rate hasn't broken out. The bottom hasn't fallen out. And inflation, while I would say is still too high, is not up at that 4 handle. But one of these sides of this stagflation environment is going to break, and the Fed is not going to have the same luxury middle of 2026 as it does now to play both sides of that.
Yeah, what she brings up is a very valid point, and Saeed and I have talked about this multiple times on the show, and I think it's important to share, is that we are essentially in a stagflationary economy, depending on your perspective of it. Now, we're not at an extreme point where if you remove one of these equations, you're in a recession. Clearly, the market is at an all-time high. And I think that's an important differentiation. Here also, please note that the treasuries are all rising, not lowering. So again, this disconnect that people have with Fed rate cuts and the treasuries going down and vis-a-vis this, the mortgage rates going down, that is obviously not happening. The mortgage rate's going to go up today, hence my comments earlier in the show. But she's right. Stagflation is a very big concern. If you have unemployment continuing to rise, right, and you do have any type of hiccup with inflation where inflation picks up, then guess what? You are in a recessionary-like economy. And there's a good argument that right now, because you're seeing this delta, if you will, and you're also seeing it with the VIX, the fear gauge. If you Google VIX or a fear gauge, it'll come up with that. It is unusual, but we've been seeing it lately where you're seeing the market rise, as in the values in the stock market, the S&P 500 going up, which again, largely carried by AI. At the same time that the fear gauge, this volatility gauge is rising. And you look at this and you think to yourself, okay, why are people getting more afraid at the same time the market is going up? That's not a normal human logic. And the only thing is there's an unwritten rule or an unsaid thing that people are afraid of, and that's a recession. They're not saying it, but that's what they're afraid of. And I'm not here to again, fearmonger or scare people, but that is absolutely kind of the underlying statement that people are worried about. And that's why you see the VIX rise the way that it has. Let's take a look at some of the Treasury conversation here.
They go in, they will exacerbate that K going forward. And that's why at this moment, this is a market, this is an economy, this is an economics profession that's going to have to think a little bit more deeply about whether we constantly go to monetary policy to solve what are increasingly structural problems and problems that are less rate sensitive. That is at the core of the statement we hear today, even if it's not explicitly mentioned, which is monetary policy is not going to solve the challenges that the U.S. is facing in 2026 and beyond, and they may actually end up exacerbating it when we rely exclusively on monetary policy.
Steve, I'm going to give you the last word before we take a little bit of a break here. Steve, you're going to be one of several reporters in this press conference with Jay Powell in the span of 23 minutes here. What exactly do you think most of the questions will be tilted towards? From my perspective, it would be what exactly has the Fed been looking at over the past several weeks if we've had no data?
I think that's a big part of it. And as I said, Dom, the lack of data shows up twice in the statement. It's kind of interesting that the person I want to ask a question of is not at the press conference. It's Jeff Schmidt. And I want to pick up on David Kelly's idea of whether or not this dissent is part of a single act by a Fed president, or is it part of a broader movement? There are a bunch of people on the committee who have expressed concern and caution about the cutting rates. And I want to ask Jeff if he's cutting rates because he's concerned about inflation being high, or is it the shutdown? Is there a reason that you don't want to do further rate cuts at all or move policy if you're out of the, if you don't have the data that you need to make those decisions? So, and I am interested in whether or not there's some caution here, because we know why Myron wants to do it. He's sort of been there and done that. But this idea of whether or not there's now somebody who will step forward and say, wait a second, maybe with this inflation rate at 3%, we shouldn't be heading forward, changes the outlook for the market. I did note that the probability of a December cut is still very high, but it's not for January. January was still around 45% last I checked. One other thing is, well, I'll leave it there, Dom.
All right. A quick couple of final thoughts from you guys. David, for you first.
So Jeff Schmidt, for those of you who don't know, is the Kansas City head who made the vote to not see the interest rate cut, which was an interesting departure. And that's how these things typically start, right? You don't see dissension amongst the ranks early on. It starts with one person dissenting and then convincing others over time, in separate conversations that might be the proper path. But the woman's point from earlier, I don't remember her name, she actually made a good point. Is monetary policy, i.e. what the Fed is doing here, going to solve the economic problems that we're facing? And I can see a compelling case where that could not solve it. I mean, if you think about the markets where we're at today, there are pieces and aspects of what we're dealing with in this particular economy which are very unique. You've got cryptocurrency, you've got gold at an all-time high, you've got a lot of businesses and industries that are struggling in meaningful ways. You have jobs, the unemployment number, and Saeed and I have talked about lagging indicators before, and you saw the gentleman from JP Morgan Chase pointing this out earlier, and then this gentleman as well. The real unemployment number is yet to be seen, not only because you don't have the Bureau of Labor Statistics reporting, but also because it's a lagging data indicator. It's a lagging plot point, and you've got a lot of things in the job market which are deceiving. You've got ghost jobs, you've got fake postings, you've got scammers out there, and then of course there's all sorts of people that are working now part-time versus full-time, and that doesn't count, and they've changed the definition of unemployment. You have to actively be looking. So all sorts of weird, nonsensical things going on there, which I think is really changing the paradigm. But the market is different. And maybe there's nothing we can do about it, because if the market's going to be driven by hysteria over AI, well, that isn't going to change a whole lot of good things or bad things.
Treasuries roll over into bills. It may be that coupons roll into coupons and bills into bills. We'll double check that and get back to you on that.
All right, we'll get the update from Steve on that clarification soon here. Thank you very much for your entire panel here. Let's now send it out to Chicago for reaction from the bond market and the pits out there. Rick Santelli joins us now from the CME Group.
Give it to me, Ricky.
Rick.
There's a lot of turns and twists here, Dom. Consider this. A 2-year was at 351 before the announcement at top of the hour. Yep. You can see that we're slightly elevated in yields, and yields were already up a little bit on the session. But here's the point. You know where they were before the last interest rate cut? So they cut on the 16th, they cut today. On the 15th, the day before the September cut, a 2-year closed at 354.
Yeah.
They're virtually unchanged. Look at the 10-year now. Okay, the 10-year was hovering right around 4%, so it's a little hotter since the announcement and the rate cut. Where was it? The day before the September cut? 404. Virtually unchanged. The dollar index, we see that it's improved slightly, highly unchanged since the 25 base point rate cut. And the day after the 15th to 16th, when they actually cut rates, is when the dollar index made its multi-year low. So the point here is we're all talking about the Fed and cutting rates. It certainly looks like December's priced in, and Jim Carrett's probably right. Probably get one more next year. But the issue is we're all looking towards the yield curve, and especially thinking about housing and the rest of the curve. But the rest of the curve is bucking the trend. We've had a cumulative 50 basis points, and basically the interest rate markets are unchanged.
That's right.
And since the October 1st shutdown of the government, the yield curve is flattening, which tells me there's nervousness that it's negatively affecting the economy. Back to you.
Rick, if I could just follow up here.
All right, the yield curve flattening essentially means that the treasuries, the near term, 2-year, for example, 3-year, 5-year, whatever, all the way up to 10-year, 15-year, 20-year treasuries, those are flattening, meaning they're kind of falling in line with one another. And what happens is the long end of the curve should always be higher than the near end of the curve. The reason why you're seeing that flattening is people have fear over what's going to happen over the long term, not over what's going to happen the next year or two, but over the next several years. And that's where you're seeing it. When people get more confidence near term treasuries rise. When people get less confident near term and more confident long term, which really should be the fundamental baseline for everybody. And the reason why is very simple, right? You've seen the markets, and we've all heard this before. If you put your money in a low-cost index fund like Vanguard's VOO, for example, and you let it sit there over the course of 10 years, you should have a pretty good return, somewhere in the neighborhood of call 8 to 10%, for example. So you know that long-term your money in the markets is generally a good thing, which is why you typically see higher yields on longer duration treasuries like we're seeing here on this chart now. What he's pointing out is also interesting, too. You have seen a bit of a flat market from the treasuries in response to the rate cuts, which is kind of going back to what Saeed and I have talked about on the show multiple times. You're not going to see mortgage rates fall back to where they were. People who thought that these cuts that you're seeing and being talked about for so long are going to drop mortgage rates and the housing market's going to rise on fire. No. To date, no one, not a single person across the country has provided a solution and proffered up an answer as to what's going to solve the housing affordability crisis. And mortgage rates going back down will only make this problem worse. Can you possibly imagine if home prices were rising because mortgage rates dropped to another near all-time low, call it 3 or 4%, and then you have the stock market at a near all-time high? Everyone would be like, this is insane. All-time unaffordability, all-time highs in the markets. If you look at them on the chart here between the Dow, the NASDAQ, the Russell, the S&P, these are all-time highs. It's not good. It's not good because if you're, and I used to always say this in the banking sector, if you're at absolute best rating, for example, if you have an A grade in your math class, that's great. You're smart. But you've only got one way to go, so you got to fight real hard to stay up. But at the same time, if you're a B and you improve to an A student, well, guess what? That's great. You've put in the work. You've improved. The market is right now an A-plus economy from the stock market's perspective, from the housing market's perspective. And guess what? No one's been doing their homework. So you should expect to see those numbers slide over time. And how and when that's going to happen, well, nobody really knows. And yet the interesting thing is, if you look at the markets and you say to yourself, okay, well, Chris, housing, the affordability needs to get better. It does. Chris, the stock market needs to show a bit of a correction. It does. Sure. But over the course of 10, 15, 20 years, it will regain to where they're at today and even higher. you have to understand that the near-term affordability is the problem. It's not the long-term these things improving. We had a massively long period of time with artificial interest rate deflation, and we are now suffering an unusual and uncharacteristic long-term adjustment period as a result of it that nobody wants to talk about because everybody's got money that they've made in their home equity and in the markets, and everybody's so wildly afraid to lose it. It's just human instinctual nature. Let's listen in a little more.
The great financial crisis lows. Something has to give at some point because inflation is still a problem. It's still out there. There doesn't feel like there's a view that it could percolate up again to the levels that we saw at 4-decade highs at points over the last 3 to 4 years. But it has to still be a concern if you're a central banker thinking about a cycle of interest rate cuts.
That's right.
Is it not?
Correct. What would you think, though, is more of a concern now? And this is what the Fed is trying to weigh. Is it price stability or is it full employment? And at this point, we're at a juncture where it is full employment. Reason why I say that is
until it's price stability, and that's what comes next.
Really do that one-time price shock to the price of goods, and you can't really get your head around that, right? When you think about it, tariffs are going higher. It's got to be an ongoing basis. They don't go up once; they stay up once. So
I disagree with that characterization a little bit.
Corporations that are passing it on, that could be different. But let's think about the Budget Act that President Trump passed. People are going to get roughly per household $2,000 coming in the door with those taxes.
I don't want to hear that because nobody cares about what you get at the end of the year. Everybody cares about their standard of living throughout the year. That's the reality. The thing that we're seeing here, and he brought up a valid point before I started disagreeing with him. Inflation has not come down. So keep in mind that inflation at 9.1%, which I believe was what it was at its height or somewhere around there, and inflation today, let's just call it 2%, is still cost of living going up. The underlying thing that nobody's really addressed is employers aren't going to just pay a ton more. They're going to worry about their profits. They've got their shareholders and fiduciary responsibilities. But at the same time, we haven't solved the affordability issue. And that seems like the easiest thing that nobody talks about is you could have payrolls go up. But if payrolls go up and company profits go down, these companies are worth less. And maybe that solves some of the high valuation problems in the market. I don't know. But nobody's really kind of proffered up a solution to that. And to his point, you are seeing things go up. And yes, right now, jobs are, again, the buzzword, like we talked about at the top of the show, buzzwords that you're going to be hearing about a lot. Job gains have slowed, job numbers, real unemployment. What's the BLS going to say when they actually do provide reports? But we're solving for that problem knowing that we're likely making the other side of the problem even worse. And that is going to be what happens with inflation, what happens with the economy, and what happens with the markets. Let's see what he's saying here.
Former president of the Federal Reserve Bank of Dallas. Let's now bring into the discussion here Richard Fisher. Richard, you and I have spoken over the years numerous times, and you've always kept a steady eye on both aspects, jobs and inflation. But inflation's always been a sticking point for a lot of folks at the Fed, you included.
Love this dude.
When it comes to the tilt of jobs versus the Fed's mandate on inflation and price stability, which do you think it should tilt more towards, given what we've seen so far?
Well, look, one of the very rare things would be to cut rates when you have 3% inflation or slightly under 3%, wherever the number is.
Right.
We always want to keep 1% real rate. So this may be as far as you can push it right now. And maybe that's what the Kansas City Fed is concerned about. We'll have to see when we get a better briefing on the commentary. I think, again, every elected official, whether they're Republican or Democrat, Trump or Clinton, worries about employment. That's where the voter base is. But it is the Fed's job to have a dual mandate and to make sure we don't have inflation or deflation. So I think, of course, you have to remember, Dom, I was a hawk. So I always worried more about the inflation side than the other side. And with regard to that, the two dissents, Myron is obviously going to do what the president wants him to. He doesn't seem to be carrying the table. You got to convince 18 other people of your argument, and he's not winning that argument. As far as Kansas City is concerned, you have to remember Tom Honig, who's one of the great leaders of that bank, was also very hawkish and voted against a lot of what we did to cut rates when I was there. So it's part of a Kansas City tradition to be on the hawkish side. I do think it's an interesting indicator. I would expect Chairman Powell in his press conference is not going to signal anything further going forward. You have an excuse with regard to the lack of data that's available. And I think the other thing to mention, I think maybe only 4 times in history or maybe less, have we ever seen a rate cut when the equity markets are rallying to this degree, being priced relative to underlying value to this degree, when the spreads are so narrow in the credit markets?
Yeah.
So I understand why a trader is rooting for more. From the standpoint of the real economy, Rick Santelli nailed it. Rates are not going down. And businesses depend on, not on Fed funds. Businesses depend on what's happening further out the yield curve. The 10-year Treasury is the most important of all in the entire world.
Yeah,
it hasn't
buddy.
moved. And Rick made the point, and I think he's right, rates have been steady through all this rate cut discussion. That's what businesses depend on.
Mm-hmm.
To be sure, all the Federal Reserve beige book stuff is showing a slowing of the economy. There are other data that are showing it holding up. And remember, these big layoffs that have been announced, those are important. But what really counts is what small and medium-sized businesses that don't trade in the market, what's happening with their employment and how are they getting the kind of workers that they want. Historically, those little bitty companies that don't trade in the marketplace are the most important from an employment standpoint. They create 80% of the jobs in America. They hold roughly 50% of the jobs. So I think the key thing to watch here is what's happening in the SME, small, medium sector of businesses, and not get too caught up in the big companies. It's really the smaller companies, the non-traded companies that move the economy.
What a stud.
So you have to diverge from the economy versus what the trading market wants to see. I understand why they want lower rates. I'm a little skeptical that they're likely to get them in December, and quite skeptical, unless the economy really implodes, that they'll get more following on that. Powell has 4 more meetings after this. And I believe, knowing him as I do, he's going to hold to principle, never give in to political pressure. And Mr. Myron may have a real difficult time convincing the rest of the committee that they need to move more aggressively.
Let the shit talking begin, boys.
That's an interesting thought. Steve, I want to get
4 more meetings before Fed's term is up in 2026. I want to say it's May of 2026. And wow, he came out swinging. This is why I love Dick Fisher. What a stud. Everything he said was spectacular and spot on. I do have concerns we're not going to see a whole lot more rate cuts. I think some of that is going to be said today. I do think the market is going to respond to that if Jerome Powell is very, quote, dovish on the idea of more cuts. And I think what you're going to wind up seeing is you're going to wind up seeing a very, very palpable and visible headline response of people saying that the narrative has changed. Now, to Dick's point, he has a lack of data that he can lean on. So you can be mad at him from a political perspective, but he can say, look, I just don't have the data. I don't have the data to make a decision here. I don't know. I don't feel good. And the rest of them can. But I tend to agree. I don't know that you're going to see as many rate cuts as people thought leading in the next year, which I don't know is necessarily a bad thing. The rate market isn't changing a great deal in response to it. So it's a big question mark right now, but very interesting narrative. He did pose the idea of a political fight, and Myron, who is the current administration's boy, and having to possibly fight with the political reluctance to back down by the outgoing Jerome Powell. I do think this will all come to a nasty political head with lots of public commentary from the powers that be in the summer of next year, which I got to tell you, I'm wildly looking forward to. But let's get back into it. We should have the press conference starting here in about 5 minutes, but there should be some more commentary going into it. Nothing I'm seeing is wildly, I guess, unexpected so far, other than that one dissent from Kansas City's, I think it's Schmidt. Mirren always does this, and frankly, it would be really interesting to not get another rate cut this year and to see maybe one projected for next year as the only rate cut. And again, if you're looking at this from a business perspective, if you're a realtor or mortgage loan officer and you're saying to yourself like, hey, I gotta tell my people, what we're going to do here, I would say look at the Treasury market. You're not seeing rates move a big deal. You've seen rate cuts and you're not seeing the 10-year move a whole hell of a lot in response to that. If anything, I think you're going to see mortgage rates go up. So, I hate to say like Dave Ramsey here, but if you're gonna buy now. But that's kind of the truth. I don't think that's going to get more affordable anytime soon.
Continue take out debt and finance their debt. This is not only good for the average person on the street, this is good for the United States of America, that their debt financing will be tremendously cheaper the lower we go. I don't think inflation, and I appreciate Richard's comments, he's an inflation hawk, and I get where he's coming from, and he is right. I'm a market participant, but I'm well-rounding this all out. I could see both sides of this. I think to get from A to Z for the economy, for the markets, we need lower rates, and we need those rates around 3%.
All right, Richard.
Yeah, I think you're on crack, guy. What are you talking about?
As the former head of a regional
Get him, Dick.
Federal Reserve
Get him,
Bank
Dick.
out in Dallas, we've spoken a lot, and maybe even speculate is maybe not the right word. We've thought a lot about what exactly policymakers are using for data in order to get the best, I guess, view possible about what the economy is doing in the absence of any government-specific data coming out of the Labor Department, of Commerce, or anywhere else. One of those things has been the use of regional Fed banks and their kind of beige book participation type data to glean a better picture of what's going on. I would like to know from you, as the former president of the Dallas Fed, just how robust is that data coming into these regional banks, and how exactly can it be used, if effectively at all, by the central bank to help guide policy?
Well, it's not just the beige book, Dom. Every president, when they go to the meetings, which just concluded, they report what they see, what they're picking up to the minute in terms of their districts. Some districts are...
I don't think there's anything valuable here. So I was hoping that Dick would go back at homeboy here who challenged him. And yes, Dick typically is an inflation hawk, but he's also started off saying that. The question in the comments here, do I think mortgage rates are going up? Why do I think that? Well, I think that the problem that we had is that you have banks, regional community banks, are going to protect their profitability. They have to build up their net interest margins, like we talked about a little earlier. In order to do that, they have to increase their mortgage rates or keep them somewhat stable while they bring deposit costs down. I also think the 10-year, which is the biggest proxy for mortgage rates, has shown a bit of resilience. And what you're seeing is a bit of a flatlining treasuries right now. And what normally you'd have a steeper curve. We came out of, not too long ago, one of the longest yield curves, if not the longest yield curve inversion in history, which had your 10-year and your longer-term duration yields below your near-term yields, which meant, from a consumer's perspective, that the market and people generally had more confidence in the near term than they did in the long term. And as people start to grow confidence in the long term, those longer duration treasuries yield. And what they're saying is, I believe that in 10, 15, 20 years from now, we're going to have a much stronger economy than we do today. And as that uncertainty pivots that way, that's what happens. That actually pushes mortgage rates up over time. When we talk about the housing market and prices down, that's a different paradigm. We've seen a really, really weird thing happen. And no one, despite how much of an asshole I like to think that I am and a genius, no one has an answer to the affordability crisis. It's not as simple as supply and demand. That's only one aspect, and I appreciate it. But we've always said on the show that demand without affordability is not, in fact, demand, because people can window shop all they want if they can't afford it. And right now we are still at all-time unaffordability as far as home prices go. So I don't know that the mortgage rates in and of itself are going to solve that problem. I would imagine at particularly some juncture, you're going to see a potential question mark come up about 40-year amortizations coming back on the market as a reliable product. Maybe that's the new standard versus 30-year amortization on homes. That concerns me a great deal, because that'll solve the problem near term and then just skyrocket prices back up in the housing market. So I don't have a good solution. I don't profess to be a world-class economist to be able to answer that question, and I haven't heard anybody smarter than me give me a good answer other than you need a correction. And I'm not saying crash 20% or more, but I'm saying a correction. And what could and most likely will be the outcome, as far as I can tell right now, is you saw 7 to 10 years from peak to peak, the trough to trough, historically in recessionary economies and in prosperous economies. And you kind of have like this sine wave. It's parabolic. Goes up, comes down, goes up, comes down. And we saw 14 years of artificial interest rate deflation, which gave us one of the most prosperous economies in modern history, frankly, in all time, really, when you look at it from a timing perspective. And because of that, you're going to see, I think, a prolongated correction period of things settling back into normal. And I think a little bit of this, I guess, dichotomy in jobs and inflation is a response to that. You are seeing abnormal things in the economy that don't make a whole hell of a lot of sense. And the reason why is because we went through 14 years of artificial interest rate deflation, and the market just skyrocketed up. You saw 50% in home value increases over a near-term window. I don't think you should expect that going forward. I think that would be unreasonable. Should you expect incremental increases? Yeah, sure, over the longer duration. But there really does need to be some type of solution to the affordability crisis. And I don't know if that's a different financing mechanism. It's certainly not going to be rates. I don't know how you get more supply on the market. And if you look at some of the housing and the builder data, which we covered on a couple shows back, it's also very skewed. So there are some corrections. Let's get into the press conference, ladies and gentlemen, boys and girls.
Jerome Powell is taking the podium as we speak.
Yes. Give it to me, JP. Game time.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments.
Oh, fancy.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected,
I don't have the
primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline.
People getting hired and the people doing the hiring.
In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
Yeah.
Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level.
I don't know
but
I agree with
it is
that.
also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
There is no risk-free
With downside
path.
risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance.
Okay.
With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion.
Ooh.
Far from it.
Leave it on the table,
Policy
baby.
is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills,
Look at that spike in
furthering
near-term.
progress toward a portfolio consisting primarily of
So your
Treasury
Treasury's
securities.
rising.
This reinvestment strategy will also help move the weighted average maturity of our
10-year too.
portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
No, he doesn't. That's a lie. Who's going up?
Nick Cimaros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
Interesting.
Some of your colleagues
should be a fascinating meeting in
last
December.
month and maybe today. I won't put words in your mouth. There's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals for a very long time, the risk.
So he's clearly hedging his bets a lot, and I think he's leading into what should be a really exciting December meeting, because you're going to have a government shutdown for however much longer you have it. You're going to have a lack of data for however long that lasts. And then on top of that, you're going to see very little significant changes. And you're going into a holiday season, let's not forget. Again, lagging indicators leading into it, but still, you're going to have no material changes. I don't expect the housing market to get materially better between now and December. And he's suggesting, without saying it, that there is a bit of dissension beyond Schmidt and Mirren in where the market should go and how many more rate cuts there are. So you saw a guaranteed 25 basis point rate cut this time. You are not going to get that level of certainty leading into December. Already, he's laying that framework.
It was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question.
No problem, Claire.
No, we've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom?
Jesus, spit it out, lady.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to.
Jesus, he's not answering the question. Basically, she wants to know who was fighting with who and why, and was AI a factor? Okay, he's never going to admit that AI was a meaningful factor in that conversation. That really isn't the direct correlation, which is why he suggested that it's a factor in kind of the overall zeitgeist, but not what they spoke about when they're making their monetary decision policies. Not really a well-articulated question, and a questionable choice in scarf by the lady.
And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term
scarf is
debt?
Shittiest. That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some of it.
Let me know if you guys want us to do on a show, maybe even tonight's show, a kind of a fuller breakdown on a couple different concepts that he's really referencing here. Quantitative easing and quantitative tightening, and how the Fed manages their balance sheet seems to be a recurring theme. That might be a good show thing. I think going off the gold standard in 1971 would be a good discussion, and some of the ramifications after that, if you guys want us to talk about it. So there's a number of things we can do here that I think are meaningful with this particular time. But let me know if you think, if you don't want to let me know here in the comments, you can certainly send us an email. It's media@higherstandardpodcast.com, and we'll get that incorporated into the show. I think you guys would like it.
Announce effective December 1 that we will be, freezing the size of the balance sheet, and the December 1 date gives the markets a little bit of time to adapt.
Yeah, he was just foreshadowing the markets. Let him know.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here?
Good
Would you
question.
then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward.
We know that.
And we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on
Answer
initial
the question,
claims,
Chief.
which are sending a sort of a signal of more of the same. We also get job openings. And
we
get
know all
lots
this.
of survey data. We'll get the beige book
Also
and things
know
like
that
that. So
too.
we'll have a picture of what's going on in the labor market.
And
the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that.
That's
so that
not
does
the
give
question.
You some comfort.
That wasn't the question.
If this
What the
shutdown
fuck
lasts
was
a lot
that?
longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area.
Yeah,
we
we
get
know
some
that, dude.
data in inflation.
We know what you
some
look
data
at.
in economic activity. And we'll have a picture of what's going on. We also will have the beige book
Holy
again.
shit. Is he not going to answer a single one of her questions, which were good questions, by the way? And the question, just to remind you, was what are you going to do if the labor market stabilizes? Because you're really cutting rates right now because you want to prop the labor market up. So she's saying if you cut rates, labor market props up, you're good, and inflation is not wildly out of control, but still rising and it's above your target, are you going to cut rates or are you going to leave rates where they are? Which is in theory what she's asking. Are you going to leave rates where they are if jobs stabilize? That was the question. Wouldn't even touch it with a 10-foot pole.
That could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, give it to me, brother.
Steve
Come on.
Leisman, CNBC.
Yeah.
Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call?
Did
maybe
Neil
the other
get
way
into a
because
fight
you had
with Mirren?
Dissents on both
That's
sides.
what we want to know.
Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's
don't do that.
It's not clearly in motion. It's not clearly declining quickly. In any case, it may be just
Are you
continuing
insane?
to gradually cool.
You don't even have the data to make that
people
call.
have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches. There are differing views on the committee, and to the point where I said what I said.
So he didn't answer the damn question again. He didn't tell him what the dissension was or why.
Stop it, the runoff now. Does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we'll be
Translated loosely, they're going to try to prop up the short-term duration treasuries and the dollar on some level to ensure that the system has proper liquidity for the size of the overall market. but because they don't feel like they need to worry about inflation rising at quite at the same cadence, but they still have to push it down a little bit. So this was something that they probably should have done, frankly, a couple meetings ago, but they were worried about the headline risk in announcing something that's significant. I don't see anything valuable here. They're just telling the market how they're going to manage it. Not too dissimilar from an earnings call.
Balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle. Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So, okay, so the September
weird question.
CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't.
Oh God, housing services inflation, also known as shelter inflation. We've talked about shelter being owner's rent equivalent and rent, if you will, measures the price changes in the services related to provide housing. So primarily including the cost of rent and owner's rent equivalent, like I noted there. It's a major component of overall inflation, but it is not going down meaningfully. And anything that he's saying right now is ignoring that there is and will continue to be an affordability issue.
Something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further.
And for those of you in the real estate industry who are listening to this saying, okay, wait, how is that a service? It's supposed to be an asset in the form of a housing. Is they translate it into a service, so they call it housing services, but you're really talking about shelter in this context and some of the services related to it, but it is really just housing.
We don't see that. I know there could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%.
Thank you.
If you look at longer-term surveys.
Thank you. That's like me saying I'm absolutely committed to doing a live podcast. It's the job, dude. Like you've already that's we all know what you're committed to. Thank you for clarifying your point there.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles?
Yes.
How is the Fed thinking about that?
They're not thinking.
So I don't think that the.
I don't think. Stop.
You're right. There are a lot of data centers being built and other investments being made around the country and around the world.
What we've talked about on the show multiple times, Saeed. I'm looking at you, dog.
Big U.S. companies are just investing a lot of resources in thinking about how AI,
it's resources,
which will be
most of us
based
say
on
resources,
those
classy guy.
data centers, run through those data centers, is going to affect their businesses. So it's a big deal.
Yeah, we know that.
I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area where there's going to be.
They're billionaires, man. They're rich. They don't care about interest rates. I can paraphrase for you anytime you guys want. Just let me know. I'm here for you. I can translate.
Sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data. But you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Ooh. Then there are fighting words. He's fighting with the president there. He's not saying it. That's what he's doing.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December.
He's going to be very careful with his words here because it's a political fight.
To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying.
Can you imagine being in a relationship and this is the way you talk to your spouse? I'm not committing to it. I can imagine that may or may not be a problem, but it's unclear based on what I'm looking at today if that may or may not change my mind in the future. Just know that I am committed to my relationship.
Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment.
What a dumbass question.
And secondly,
that's all he's been talking
some
about.
of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do.
You mean Amazon laying off 14,000 employees?
Carefully.
Yeah.
We know. Yes, it could absolutely have implications for job
Could?
creation. We don't really see it in the
the
initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that.
Why do you need the data on the jobs that we all read in the headlines have already been cut in order to make a decision related to jobs? I mean, that is insane. That's like walking in on your wife cheating on you saying, I need to talk to her and see if she really cheated on me. No, you saw it, dude. We all saw it.
Calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth.
Yeah, that's real.
And so much anecdotal data on that, and so we think there's something there.
You think? So you do listen to the higher standard. That's what I'm hearing.
Edward. Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So,
back at it, brother.
So, if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So, if it's not lack of data as the reason December is not a foregone conclusion, what other things?
He's afraid of inflation.
Perspectives of people on the committee.
Hello.
That we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think
above the median, he basically suggested that the majority of the FOMC members believe that they are at a neutral rate, and that is where they should stay. So if that's the case, you would not get a rate cut in December without material data coming in to change their perspective.
That the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's
see how it goes.
From some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Near-term employment, long-term inflation.
Everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September summer.
Interesting statement. We are 150 basis points closer to neutral, but he's already suggested that there is an overwhelming majority, i.e. more than half of the FOMC members who believe that they are at the neutral rate. So he's dovetailing his words here very gently, but effectively saying we've cut 1.50%, and we feel pretty good this might be neutral.
The job market is weakening right now, and what will this rate cut do to improve the job market?
Yeah, good question.
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and you know, so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. You know, it's mostly a function of
yeah, I disagree almost entirely. While immigration is a problem, we're going to see peak up in the job numbers. I don't think we've seen that data peak up to them yet, and he's already talked about data. I think the jobs market has been weaker for a prolonged period of time than they've been willing to acknowledge. We've seen it. We believe for a long time that inflation was higher to me, to the average consumer than expected. We thought it was closer to over 20% inflation impact to us when they were saying it was around 9.1%. So for him to say that jobs are, it's a seasonal thing, and some immigration issues, yeah, I believe that both of those are going to be problematic and those are going to be represented in the data, but that data is going to be coming out in Q1 of 2026, not now. What you're seeing now is you are finally acknowledging the weakness we all felt in the labor market for the last 6 months, and to suggest that political policy, which is wrong and has all sorts of issues, is causing this. Now, and what you're seeing just shows a complete departure to the data, which you know you're already getting limited amounts of now because of the BLS's current status as being on furlough.
And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and
yes,
some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
Okay, you know what, dude? Fuck that. Okay, it's not I hate the supply and demand argument. It's the most rudimentary argument in all of economics, and it's asinine because it's like the high-level, top-tier view. A lot of real estate people do this, and that it overlooks affordability, cost, value, so many other factors, and just looks at the end result. And look, while I understand that we've all been taught that in your basic economics 101 course, it does not mean that is the issue here. And let's be clear, if the supply of workers on the market was low, people would be hiring and there would not be high unemployment. What you're telling me is there's seasonal issues, this and that, and blah, blah, blah. Okay, unemployment is low relative to where it's been, but it's been creeping up, and we feel that the job market is weak. If anything, everybody I know who's applied for a job in recent months, frankly the last year, has had a very, very difficult time getting a job. That is not because the supply of people trying to get a job is low. It's because there's a number of job postings is low, which goes against complete opposite of his rhetoric of, this is seasonal. And the immigration issue. Okay, if this is an immigration issue and people are leaving the country because of immigration, they're not allowed to come in, which is what I'm believing he's suggesting here, given the current economic and political climate, then there should be more job openings and more hirings and less unemployment, but you're seeing unemployment go up. So I don't understand how the hell he gets there. I mean, maybe I'm just disconnected. Tell me in the comments if you disagree.
It stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Mike. Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
Yes. We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. Yes. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there.
I agree. Yeah.
We use our tools to support the labor market.
Jerome Powell and I agree on that one.
To create price stability. That's what we do. That's our two jobs, right? So,
but
we're here
is it working?
By lowering rates at the margin that will support.
No disrespect to him. Is monetary policy in that sense, jobs and stable economy, is that working? Monetary policy and stable employment? I don't know. You've got a really weird economy where you've got things that are happening that are very strange, and we're not acknowledging. We're just not acknowledging the fact that some of this stuff seems to be giving very different messages, and we don't know if this is solving the problem.
We know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
90s,
this is different.
Interesting.
In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas
well, let's pose the question here, though. If the companies now do have earnings, and your argument is that because they have earnings, they're not a bubble, I would argue that the earnings that they have are dependent on their delivery to the market of the expectation of this technology. And yes, while you are profitable as companies and you'll be okay as a company, that doesn't mean that the AI models are going to deliver. And a great example of this, and I spent a lot of time with AI here, is that just because a model can reason doesn't mean that it has achieved AGI and can actually reason independently in a meaningful way that'll help a company. And right now we're seeing some good reasoning, but we see a lot of mistakes too, a lot of mistakes. And we are seeing improvement. Delivering on the promise that is driving their revenue is key to them maintaining and thus growing their revenue, paying for a lot of those data centers and electrical stuff that we've been talking about the entire show.
AI, you could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much?
Because it's a barbell economy.
Is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation.
No.
So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of
at least he's acknowledging that demand has gone down.
So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse.
UPS, 48,000 employees. Amazon, 14,000 employees. We thought it was up to 30. Intel, 24,000. Nestle, 16,000. Accenture, 11,000. I talked about all this at the top of the show. Ford, 11,000. Microsoft, 7. PwC, 5,600. Salesforce, 4,000. Softening, dude? Come on.
Context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come up, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, so I don't know whether we'll face this or not. I hope we don't.
It's so contradictory.
I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown?
There you go. So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say,
he's going to regret that.
We didn't get the September.
He's going to regret that so much.
Payroll report, but we look at the unemployment insurance claims initial.
All right, I'm going to let Tickle Shits go on here for a little bit while I explain something. Okay, so I just read off a list of employers who let meaningful people go, meaningful job reductions. He cited himself, not me, he cited himself, the immigration policy, workers leaving, and none of those companies sounded like those were the jobs that they were fulfilling for the most part. I mean, there's probably some, but not a lot. So for him to suggest that we're not going to see huge changes in the labor market, and to his point, seasonal, but not to his point in that the strength of the job market, we have seasonal jobs in place now for the holidays, and those people then turn around and be unemployed again post-holiday. So for him to suggest that we're not going to see increases in unemployment is pretty damn strange. You have not seen this data that you know is out today in the reports that you're looking at to make your decisions, which is asinine and backwards and all sorts of stuff, but it's just the reality of how this works. For him to suggest that it's not going to be improving so cavalier is just dumb.
Low as well, 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job. But it is absolutely the best thing we can do for people, along with keeping prices stable. Those two things. I mean, inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and
they get all reappointed in 5 years. But let's be honest, Jerome Powell's like, man, I'm out of here. My term is up. I do not care. He doesn't want to answer this question other than to give the logistics of how this works. But let's be honest, he's going to have very little input into who gets hired and why.
Dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path.
You can write Mirren off from being both directions.
Have these disagreements complicated your role presiding over the FOMC meetings?
Yes, it has complicated it.
I wouldn't say that, no.
You're a liar.
I think
He's lying.
You have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Jennifer, last question. Give it to me.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned,
cockroaches?
When you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back.
Wealthy getting wealthier, poorer getting poorer.
Spending continuing hinges on the stock market remaining strong. In some odd way, does the market help keep the economy buoyant?
Yes.
So there is some There's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting
Actually, the data says
right
otherwise. Data says 30% of the market,
and you would see it if you saw a material correction in spending, but
not really.
It wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case.
She didn't say that.
Thanks very much.
Oh, I'm gonna miss you so much, Uncle JP. I'm gonna miss you so much. All right, well, that's going to be the end of our stream today, kids. If anybody has any questions, feel free to shoot those over. If you guys want to talk about more of what we watched today or went through, we are always open to doing so on the show. Just let us know exactly what it is you want to talk about. If you made it this far, please, and if you're not subscribed, please do. Give us a comment. That actually means a whole lot to us in the comments down below as this video helps it get pushed out to more people. But thank you, everyone. There are a number of you still here. Thanks for tuning in. Really sincerely appreciate you. And, next week we'll see you on the show, and look forward to it live. Oh, and one last thing. If there's anything that you guys want to see from a live perspective other than the FOMC meetings and some of the stuff that would come up, let us know. I'd love to cover more stuff live. I just need to know what's interesting to you. All right, guys. See you next time. Bye!